Financial statements are the raw data of business, but on their own, large numbers on a balance sheet or income statement can be difficult to interpret. Ratios allow us to normalize this data, creating meaningful comparisons between different companies or against a firm's own historical performance. Today, we're conducting an in-depth review of ratio analysis, organized into four critical pillars: liquidity, solvency, efficiency, and profitability. We will move beyond just memorizing formulas. We'll explore how these metrics interact to reveal the operational reality of a business. Whether you are an investor looking for value or a manager looking for waste, these tools provide the diagnostic lens necessary to see through the complexity of modern accounting. Let's begin with the most immediate concern for any business: its liquidity. Liquidity refers to the ease with which an asset can be converted into cash at its market price to cover short-term debts. The current ratio, or working capital ratio, is your primary indicator. It's calculated by taking all current assets, cash, accounts receivable, and inventory, and dividing them by current liabilities. A ratio above 1 suggests the company can meet its obligations due within the year. However, not all assets are equally liquid. This is why we use the quick ratio, also known as the acid test. This measure excludes inventory from the numerator because selling off stock can take time and often involves price markdowns. Imagine a high-end jewelry store. They may have millions in current assets via gold and diamonds, giving them a high current ratio. But if no one is buying, they can't pay their rent with a necklace. The quick ratio reveals that vulnerability by focusing only on assets that can be turned into cash within roughly 90 days. It provides a more conservative and realistic view of a company's immediate survival capacity. While liquidity looks at the immediate horizon, solvency measures a company's ability to meet long-term financial obligations. This brings us to the concept of leverage, the amount of debt a company uses relative to its equity to fund operations. We analyze this using two key metrics. First, the debt-to-equity, or D/E ratio, which divides total liabilities by stockholders' equity. If a company has a D/E of 2.0, it means for every dollar shareholders have invested, the company has $2 of debt. This is common in capital-intensive industries like utilities, but risky for volatile tech startups. Second, we look at the debt-to-assets ratio. This tells us what percentage of the company's total resources are financed by creditors. If the ratio is 0.6, 60% of everything the company owns, from its buildings to its patents, is essentially owed to lenders. High leverage can amplify returns during good times, but it creates a high fixed cost of interest that can lead to bankruptcy if revenue dips. Solvency analysis helps us determine if a company's capital structure is sustainable over the long haul. Efficiency ratios measure how effectively a company utilizes its assets to generate revenue. The broadest measure is the asset turnover ratio, which takes total sales revenue and divides it by average total assets. It tells you how many dollars of sales you get for every dollar of assets you own. To get more granular, we look at turnover for specific parts of the balance sheet. Accounts receivable turnover tells us how many times a year we collect our outstanding customer credit. A low number here might indicate that the company's credit policy is too loose or its collection department is struggling. Inventory turnover measures how many times a year the entire stock is sold and replaced. A grocery store might have a turnover of 20, meaning they refresh their shelves every few weeks, whereas a car dealership might only have a turnover of 2 or 3. Finally, the accounts payable turnover ratio shows how many times a period a company pays its vendors. Together, these turnover metrics reveal the velocity of the business, how fast the gears of the company are actually turning to produce cash. To turn turnover ratios into actionable management data, we convert them into days. Days Sales Outstanding, or DSO, is 365 divided by the receivable turnover. It's the average time it takes to get paid. Days Inventory Outstanding, or DIO, is the time stock sits in the warehouse. Adding these together gives us the operating cycle. But we also have to consider when we pay our own bills, which is Days Payable Outstanding, or DPO. The final metric is the cash conversion cycle, DIO plus DSO minus DPO. This represents the number of days a company's cash is tied up in the production and sales process before it returns as profit. For example, if you take 40 days to sell inventory and 30 days to collect payment, but you pay your suppliers in 35 days, your cycle is 35 days. A company with a very short or even negative cycle, like some major retailers who get paid by customers before they ever have to pay their suppliers, has a massive competitive advantage in liquidity and growth potential. Profitability ratios are the bottom line metrics that interest shareholders most. We start with net profit margin, which is net income divided by total sales. This tells you what percentage of every dollar of revenue actually reaches the bottom line after all expenses. Next is return on assets, or ROA. This measures how much profit is generated by each dollar of assets the company controls. It's a great way to compare companies within the same industry, regardless of how they are financed. However, the gold standard for shareholders is return on equity, or ROE. Calculated as net income divided by stockholders' equity, it measures the profit generated relative to the money shareholders have actually invested. If a company has a high ROE, it suggests they are excellent at reinvesting capital to create value. But as we'll see in a moment, a high ROE can sometimes be misleading if it's driven primarily by high debt rather than operational excellence. To truly understand the quality of a company's return on equity, we use the DuPont analysis. This framework breaks ROE down into three distinct components: net profit margin, asset turnover, and the equity multiplier. By multiplying these three, we get the ROE. This deconstruction is powerful because it reveals how a company is making money. Is the ROE high because they have high margins on every sale? That's net profit margin. Is it high because they move a massive volume of goods? That's asset turnover. Or is it high simply because they've taken on a lot of debt to buy more assets? That's the equity multiplier, which is the reciprocal of the percentage of assets financed by equity. If you see an ROE increasing over time, you can use DuPont to see if it's due to improving operations or just increasing financial risk through leverage. It is the ultimate diagnostic tool for any financial analyst. Finally, we must look at how the stock market values these internal accounting results. Earnings per share, or EPS, is a fundamental metric. It's calculated by taking net income, subtracting dividends on preferred stock, and dividing by the average number of outstanding shares. This tells us exactly how much profit belongs to each share of common stock. We then use the price to earnings, or P/E ratio, to see how much investors are willing to pay for $1 of those earnings. A high P/E often indicates expectations of high future growth. Similarly, the price to book, or P/B ratio, compares the company's market cap to its book value, or what the company is theoretically worth on paper. As we conclude, remember, ratios are not answers, they are questions. A high ratio might be a sign of strength or a warning of a bubble. You must always compare these numbers against industry averages and the company's own history to find the truth. Thank you for joining this masterclass in accounting ratio analysis.